Have you ever stopped to think about how a giant company, like Apple or even just your favorite local coffee shop, tells the world if they're winning or losing? It's not like they just shoot you a text. No, they use a special language, a kind of universal language of business. And that language is accounting. And it all starts with a pretty basic question.
So yeah, how does a business tell its financial story? How does it communicate its wins, its losses, its value, and its performance to all the people who need to know? That's really the core question we're going to dig into today.
You see, it all begins with this idea that every single financial thing that happens, from selling one cup of coffee to buying another company for $1 billion, is like a word, or maybe a sentence, in a much bigger story. Accounting is just the process of taking all those little transactions and weaving them into a narrative that actually makes sense.
Now check out this official definition from the American Institute of Certified Public Accountants. What's super interesting to me are the verbs they use: recording, classifying, summarizing, and, this is the key one, interpreting. This tells you it isn't just about passive number crunching, right? It's a really active process of making sense of everything and telling a story about what it all means.
And just like any language, you need rules. You have to have them to make sure everyone is speaking and reading it the same way. I mean, without a common grammar, the whole story would just be chaos. This grammar is what gives us consistency and clarity.
So, that set of rules is called GAAP, which stands for Generally Accepted Accounting Principles. The easiest way to think about GAAP is as the official style guide for financial storytelling. It gives companies the framework they have to follow so that, say, an investor in Tokyo and a banker in New York can look at the very same report and understand it in the exact same way.
And right at the heart of that grammar, there's one rule that's more fundamental than any other: the dual aspect concept. This is the big one. It basically says that for every single transaction, there are two sides to the story: an action and an equal opposite reaction. Nothing just happens in a vacuum. To see what I mean, let's go back to our coffee shop.
Okay, so this slide shows it perfectly. Let's imagine our little coffee shop buys a brand new $3,000 espresso machine. The business got something of value. That's an asset, the machine itself. In accounting speak, we call that a debit. But to get it, the business had to give something of equal value. In this case, cold, hard cash. That's a credit. So one account goes up and another goes down by the exact same amount. The books stay perfectly, and I mean perfectly, balanced.
So, we've got the rules in place, but how do we actually write this story down? How does a simple thing like buying a bag of coffee beans become part of a company's official history? Well, it follows a really clear step-by-step process.
This is pretty much the whole accounting cycle in a nutshell. First, something happens. You make a sale, you buy supplies, you pay an employee. Right away, that event gets recorded in the order it happened in a thing called the journal. Then, that entry gets sorted with other similar transactions in the ledger. And finally, all of this data gets bundled up and summarized into the big final reports that tell the overall story.
Here's a really simple way to remember the difference. Just think of the journal as the business's diary. It jots down everything as it happens, day by day. The ledger, on the other hand, is like the library, where all those diary entries get sorted onto the right shelves. All the cash stuff goes on the cash shelf, all the sales go on the sales shelf. It makes it super easy to see the total for any one category.
Okay, so after all that recording and sorting and classifying, what's the payoff? What do we get? Well, we get the main chapters of the financial story. And these are the big reports that answer the two most important questions anyone could ever ask about a business.
The first big chapter is the profit and loss account. This tells the story of how the business performed over a period of time, like a whole year. It answers that one simple question: did we make a profit? It does that by lining up all the revenues against all the expenses. The second chapter is the balance sheet. Now this is different. It's a snapshot, a picture taken at a single point in time that answers the question, what are we worth right now? It does that by listing everything the company owns, its assets, and everything it owes, its liabilities. And what's really cool is how the profit or loss from one report directly changes the worth shown on the other. It's all connected.
So you might be thinking, this is a lot of trouble to go through. Why does this whole story even matter? I mean, who is the audience for this incredibly detailed financial story? And what do they even do with it? Well, the answer is basically everyone who has a stake in the business. The audience is actually huge. You've got the owners and managers. They're reading it to figure out where to steer the ship next. You've got investors who are trying to decide if the company is a good place to park their money. You have banks and creditors looking to see if the business can be trusted to pay back a loan. And of course, the government reads it to make sure everyone's playing by the rules and paying their fair share in taxes. So, at the end of the day, you see that accounting isn't really about math, it's about translation. It's the script that every single business, big or small, has to follow. It's the language of success and failure, of risk and reward. Now that you know the basics of how to read it, what stories will you start to uncover in the world around you?